Welcome to It's the Economy. Today I have with me one of my favorite economists, Chetan Ahya, the chief Asian economist at Morgan Stanley. And he's joining us from the sidelines of the Asia Investor Summit, the 21st Asia Investor Summit of Morgan Stanley. Chetan, thank you very much indeed for joining me. I'm actually dying to ask you about India, but since it's an Asian conference, the first question is, you guys see Asia as in an inflection point in 2023. Why are you so bullish on the Asian economies in 2023?
So, Lata, I think the title that we had for our year ahead outlook was that 2023 will be the year of disinflation. And the key premise for our constructive view on growth outlook is that we think inflation will decline rapidly towards central bank's comfort zone. So by the middle of next year, we will have 90% of regions, central bank having inflation within their comfort zone. And that means that the central banks will not have to take rates into restrictive territory, supporting domestic demand. And that domestic demand strength, we think, will allow Asia to outperform US growth. So for Asia, we expect GDP growth to go from 3.5% right now to 4.6% in second half of next year. And at the same time, we're expecting the US growth to remain weak at around 0.5%. So that means that the differential between Asia and US growth will continue to widen, and that will make Asia look very attractive on a growth perspective.
Well, Chetan, I'm going to throw some skeptical questions at you, not because I want to disbelieve your thesis, but just to strengthen my belief. You know, we have just got the October trade data, and I asked even Jonathan this. The October trade data in India is a contraction, 16% contraction year-ago levels and month-ago levels. That has its impact on GDP, even if it is a smaller part. We are not a very export-dependent country. Asia is much more dependent on export growth, Asian economies. Don't you think this is going to, drag down Asia?
So look, I think we are expecting the external demand to remain soft, at least in the first half of next year, and the second half you should see some improvement. But I think there are three reasons why we think that domestic demand will be strong and it will offset that weakness in external demand. So the first is that, as I mentioned earlier, since inflation is coming in control much faster, policy rates will be not having to go up into restrictive territory, and that will support the financial conditions in the regional economies. At the same time, we are expecting the dollar to weaken, we're expecting the US rates to decline, and that will support Asian financial conditions in addition to support that domestic demand. The second reason is that we are still to reap the full benefits of reopening. So if you look at the services sector, particularly tourism-related activity, it's a significant chunk of the economies and GDP, and we have not seen that full realization of reopening benefits. So for example, in case of China, you're going to see that benefit coming in through from second quarter of next year. In Japan, you're going to see that benefit coming in through, and also the rest of the region will see that benefit. And the third is that for a country like India and Indonesia, we are seeing that they are having their own business cycle now because the corporate sector balance sheet is clean, banking system balance sheet is clean, and therefore that's allowing for a recovery in credit growth and domestic demand support coming in through that. At the same time, we are seeing both these economies, governments, implementing structural reforms that's encouraging private investment. So, these are the three reasons, monetary policy not being too tight, reopening benefits, and then idiosyncratic factors affecting India and Indonesia.
Okay. What's your view on capex in India? I mean, we've not seen any big projects being announced except in perhaps renewables. Banks show a lot of credit growth, but that's more retail driven. Do you expect the capex cycle to grow, or are you already seeing it underway?
Well, it is already being seen. If you look at, the CMI projects under implementation, that has picked up quite nicely. At the same time, banks' credit growth for industry has also started to show a recovery now. Retail credit growth is higher, but in terms of the momentum, you are seeing a pickup in the industrial credit growth as well. And at the same time, we are seeing these announcements coming in from multinationals to invest into India for outsourcing. So, the Apple's supply chain is a case in example. Then we heard about the Tata and the Airbus project getting announced in Gujarat. So we are seeing a lot of these investments on an anecdotal basis coming in through. But, I think the big picture story is that, at this point of time, the corporate balance sheets are in a good shape. You have that, support from structural reforms. Corporation tax reduction that happened, Lata, we never really had the time to see the utilization of that corporate tax reduction in the supply side response. It's happening only now because we had the COVID situation to handle. But now that COVID situation is behind us, we are seeing that supply side response from the corporate sector, and the capex cycle is already picking up.
Okay, that's very convincing, Chetan. But just one more, devil's advocate, a skeptical question. What about this K-shaped recovery? A lot of the staples companies, be it Hindustan Unilever or Marico or Dabur, many of them have reported only low single-digit volume growth. Whatever little realization, it's more price-led growth. As well, two-wheelers tell us the entry-level segment is not doing too well. Would that be a bother?
So we think that, whenever you're thinking about rural India, it will always be lagging the urban recovery. So if you go back to 2003 to 7, that's kind of what happened. In the initial phases, you started to see pickup in the urban economy, manufacturing investments picking up, job creation picking up, and then you will see migration, and then there will be a follow-through of demand improvement in rural India. The other thing which is affecting the farmers is terms of trade. So we've seen a big rise in WPI inflation and commodity prices, while at the same time, if you think about the MSP or minimum support price increases for farm produce, that's not been that strong. But going forward, we are expecting, you already saw that, WPI print has been coming off. And going forward, as commodity prices come off on a YOY basis, at the same time, the farm product price increases are still maintaining at a healthy level of 5 to 7%. That improvement in terms of trade will also begin to help rural demand.
Chetan, you referred to the 2004 to 2008 period, and sometimes it feels like that because we are starting with cleaner bank and corporate balance sheets. But your forecasts are all sub 6.5% GDP growth up until FY25. You think it's going to be a big ask to get, or is there an upside bias? Is it possible we'll get to 7?
I think for F2024, I think the risks are more balanced because, you do have this global slowdown that is taking place right now.
Sure.
So you mentioned about, exports being weak, and that's the key reason why we have GDP growth at 6.2% for next year. Okay. But the year after, I think you have some potential for upside risk, and of course that will depend a lot on what happens to the rest of the world or what happens to export growth dynamic. But then, in F2025, we are still expecting a pretty reasonable growth of 6.5%.
Okay, a final question again from a skeptic. In 2008 and 9, I very clearly remember we kept saying that this is a OECD problem. This is a, Atlantic seaboard problem. It's not a global problem. But 3 years later, it very much became an India slowdown as well. Do you think we can take growth for granted, or will it still be contingent on, us getting the right policies?
Well, so in 2008, we had a pretty big recession. And to the extent to which that we had a proper balance sheet recession in DMs. Yes. But in this cycle, we think there are a few different circumstances which is going to ensure that we don't have a deeper recession. So we are expecting US GDP growth to be weak, but we're expecting it to be about 0.5% next year. And the key reason why we don't see a deeper recession is that the balance sheets are in a very different shape. So if you take the US household balance sheet, 90% of their liabilities are fixed interest rates. 98% of mortgages in the US are fixed interest rates. And at the same time, for the corporate sector, if you look at the riskiest component of the corporate sector, which is high-yield corporate sector, that sector has termed out its debt, i.e. that over the next 2 years, you only have about 10% of their liabilities falling due. So that's going to ensure that this interest rate increases that you have seen in the US does not impair either household or corporate balance sheet, and you don't get a significant retrenchment in demand because of this interest rate increases. So I think this unique aspect of the U.S. balance sheets in this cycle is what makes us believe that you're not going to have that deeper recession that you had in 2008. And so if you're going to have a soft landing in the U.S., it then therefore makes us believe that India can get away without seeing a huge negative impact out of the U.S. slowdown.
This is music to our ears because there are always those Cassandras. Just a final question, because investors will want to know, do you think the pressure on the rupee is over? I don't know if it is your mandate to guess the level, but do you think we can go beyond 83, or are the pressures behind us?
So we think that the dollar has peaked, and on your channel I've explained this point earlier, that if you look at the rupee on a trade-weighted basis, it's relatively fat. So the rupee has depreciated against the dollar because the dollar has been appreciating against all the other currencies. So to establish my point, if you look at your rupee versus euro or yen or British pound, rupee has actually appreciated. So the challenge for the rupee in the last few months was really that ratcheting up of the U.S. interest rates and therefore the rise in the U.S. dollar. Now our expectation is that the Fed rate hike expectations that were priced in the market are closer to the peak. And therefore, we are expecting the U.S. rates, i.e. the 10-year bond yields, to come down to 3.5% by end of next year. And our global macro strategy is expecting that the dollar will decline to, DXY will decline to 104. And so that will mean that the rupee will also see some appreciation trend going forward.
Oh, that's good to hear. Chetan Ahya, it was a pleasure speaking with you. Thank you very much for joining us and, of course, giving us an optimistic view of 2023 and behind. With that, we wrap up this special Morgan Stanley View. Thank you very much for watching.